There is a second tax on RRSP withdrawals after 65, and almost no one talks about it. For one Canadian retiree, it cost $7,000 on a $10,000 draw. The CRA did not send the bill. Service Canada took it out of his GIS check 8 months later. Here's how that happens. GIS, the Guaranteed Income Supplement, is a monthly federal top-up Service Canada pays low-income seniors on top of their OAS check, the federal pension most Canadians start at 65. If your retirement income lands below about $22,000 as a single senior or $54,000 as a couple, you qualify. And Service Canada pays up to $1,100 a month on top. The GIS Clawback hits that RRSP dollar a second time, on top of marginal tax. By the time we wrap up, you will know the rule, the trap, and the one RRSP move that protects you from it. And here's why so few people see it coming. The clawback doesn't arrive in an envelope from the CRA. It arrives as a smaller GIS check the next July. Clawback is the government's word for taking part of a benefit back when your other income climbs. For Robert, the dollars feel the same either way. They're gone, and the check he was already entitled to is smaller for 1 full year. These 2026 figures also index again on July 1st, by about 1%. The threshold and the check both climb a touch when the new tax year's number lands. So that 50-cent rule that drives this is what's next. Robert's $7,000 price tag is what's on the line. The roadmap is short. First, how GIS actually computes, what counts as income, what doesn't. Then the 50-cent rule and the one exemption the math always uses against you. The third piece, Robert's actual numbers, is where most people get this wrong. We close on the TFSA sequence that flips Robert's 70% into 0. Here's the first thing to understand about GIS. It's paid by Service Canada, not the CRA. And the CRA's only job in the calculation is the one line at the bottom of your tax return. That line has a number. Line 23,600, the bottom line net income on your tax return. Every dollar from CPP, every RRSP withdrawal, every RRIF draw, employment income past the exemption, dividends, interest, the taxable portion of capital gains, all added up. 3 things don't land on that line: OAS itself, GIS, and TFSA withdrawals, because the TFSA is tax-free coming in and tax-free going out. Tax professionals consistently point to line 23,600 as the line Service Canada watches. Now here's where the timing matters. Service Canada uses last year's line 23,600 to compute this year's GIS. Every July 1st, the new payment amount kicks in based on the T1 you filed that spring. There's a 1-year lag, and the lag is the trap. A decision in 2025 lands on checks starting July 2026. One last piece. This isn't the OAS recovery tax we covered before. That hits high-income retirees above roughly $90,000. The GIS clawback hits low-income retirees more than 3 times as hard. Different line, different rate, different agency, same indexing season, 2 different traps. So that's how GIS knows what to pay you. Now the next question is how it knows what to take away, and how fast. Okay, that brings us to number 2, the rule that does the taking. For every $2 of other income above your threshold, Service Canada takes $1 of your GIS back. 50 cents on the dollar. That's the rule. There's one carve-out the government built in, and it only applies to one income type. If you work part-time in retirement, the first $5,000 you earn from a job or self-employment is fully exempt. Service Canada doesn't count it. The next $10,000 is half exempt, which works out to 25 cents on the dollar coming off your GIS in that middle band, not 50. Past $15,000 of work income, the full 50-cent rule kicks back in. And here's where most explainers get this wrong. They say 50% reduction on income between $5,000 and $15,000. That's the wrong shape. The $5K to $15K band is 50% exempt, which means 25 cents on the dollar comes off your GIS, not 50. The government actually built in a head start for the first $5,000. Among retirement planning explainers, this rule is the most commonly misreported. And one more thing on this exemption. The exemption is for work income only. CPP, RRSP withdrawals, RRIF draws, pension income, interest, dividends, capital gains, all of them get the full 50-cent treatment from $1 above your threshold. That's the rule in the abstract. The shape of it changes when you put a real Canadian retiree behind it. His name is Robert. Robert is 65, Ontario, single, with about $42,000 of base income a year. About $740 a month comes from OAS. The rest comes from a small RRIF he converted from a modest RRSP. His GIS cutoff as a single senior sits at around $22,000 of other income. This is where the math gets personal. At 64, he pulled $10,000 from his RRSP to use up low bracket room before RRIF conversion. That $10,000 landed on line 23,600. Service Canada used that line the next July to compute his GIS. The 50-cent rule on the dollars above his threshold took about $5,000 of his GIS away. The Ontario marginal rate took another 2. Robert kept 3 out of his 10, 70%. Think about that for a second. The CRA took roughly 20 cents on every dollar he drew. Service Canada took another 50. The second tax is not a separate check. It is the absence of a check he was already entitled to. Service Canada uses last year's tax return to decide what they pay this year. Robert's penalty arrives 8 months after the decision he can no longer unmake. These numbers assume Ontario combined first bracket rates. BC runs a few points lower, Quebec and Alberta a few points higher. But Robert keeps somewhere between $2,500 and $3,000 of his 10, regardless of where he lives. Quick pause. If this section just paid for itself in your head, hit like so the algorithm sends it to someone else who needs the same math. That's the trap. The fix is the same person, the same $10,000, and a different account. Now the final piece, where Robert keeps every dollar. Same $10,000, different account. Robert pulls the same $10,000 from his TFSA at 64 instead. TFSA withdrawals don't show up on line 23,600. Service Canada never sees the draw. GIS at 65, preserved in full. Marginal tax, 0. Real cost, 0. $7,000 kept on the same draw, but the TFSA is the rope, not the ladder. Once you pull it, it's gone. Build the room before 65 if you can. Every dollar you shift from RRSP to TFSA while your income is low is a dollar that won't count against your GIS after 65. Now, one more trap most retirement planning videos miss. If you'd qualify for GIS at 65, deferring OAS to 70 throws away up to $13,000 of GIS every year you wait. You cannot receive GIS without receiving OAS. The bigger OAS check at 70 cannot earn that back. If you're married, pension splitting can drop one spouse below the OAS clawback line. It cannot do the same for GIS. Service Canada adds your two incomes together, and there's no splitting your way around it. And GIS isn't like OAS abroad. 6 straight months outside Canada, and the checks stop, even if you've lived here 50 years. That's the fix in your own hands. The other half, making sure Service Canada uses the right line, runs through the form you file every spring. Okay, here's where I'd start. Robert's RRSP withdrawal hit line, 23,600, the line Service Canada used to compute his GIS the next July. If you don't know what your own line 23,600 will be, you can't plan around it. This part of the video is an affiliate link. If you sign up, the channel earns a small commission at no cost to you. Several tools file the T1 cleanly, including TurboTax, H&R Block, GenuTax, or paper. I link to Wealthsimple Tax because it flags GIS filers and attaches the renewal form automatically. It's free T1 filing software. 3 things in particular. It shows line 23,600 on the summary screen before you submit. It attaches the Statement of Income Renewal form to your T1, so Service Canada's recalc on July 1st has the right number. And it pulls your prior year carry-forwards, so the sequencing decision Robert got wrong is visible first. What it doesn't do is decide which account to pull from. That's the lesson of this video, not the product. It doesn't file the initial GIS application outside of auto-enrollment, and it doesn't replace an accountant for spousal RRSP attribution or multi-year RRIF sequencing. That's the filing piece. The decision underneath it is what Robert missed, and that's where most plans break. $7,000 gone on a $10,000 draw surprises most retirees the first time they see it. The rule behind why a chunk of every RRSP withdrawal always disappears, even before you cross the GIS threshold, is the video I just posted on RRSP withdrawals. Same trap, different lever. It's called Miss This RRSP Rule and Lose Half Your Withdrawal to Taxes, and it's the rule the rest of the channel is built around. If Robert's 70% surprised you, half on every RRSP dollar will surprise you more. And it shows up on the very first dollar you draw, not just past the threshold. The GIS clawback letter will arrive on its own schedule. The fix has to be in place before the letter does. These videos are short on purpose. The cost of missing one is not. Subscribe so the next GIS or OAS piece reaches you on time. Public information, not professional advice. Verify the numbers in your own situation before you act. Thanks for watching.